Your rent notice arrived last week. You looked at the number, did the math and felt it. That quiet tightening in your chest. Maybe you work downtown, maybe you commute past the same office tower every morning. It's lobby dark by 9. It's parking garage half empty by noon. You have noticed this, most people have. But almost nobody has asked the obvious question. Who borrowed the money to build all of that? The commercial real estate market sits on $1 trillion in loans coming due right now. Not in 10 years, now. Morgan Stanley's chief investment officer published research in January 2024 estimating $1.5 trillion in commercial real estate debt maturing through 2025 alone. And property values are falling. Office buildings in major American cities have lost 20 to 30% of their value. According to Federal Reserve Vice Chair Michael Barr's testimony in November 2023. The tenants left, the leases expired. The buildings sit quiet. So somebody borrowed enormous sums of money against properties that are now worth less than the debt. That is the problem, but the problem is not evenly distributed. Here is what most coverage gets wrong. The conversation about commercial real estate keeps circling the same names. The big Wall Street banks, the ones you see on every corner. That is not where most of this debt lies. In February 2024, FDIC Chair Martin Gruenberg stated publicly that American banks were holding $2.7 trillion in total commercial real estate loans. That number should stop you cold. $2.7 trillion held inside the banking system. Right now. Jerome Powell told Congress in March 2024, directly and on the record, that some banks have concentrated exposures in these areas and some of them will have problems. By the end of this video, you will know exactly which category of institution is holding the most dangerous slice of this debt. And why a specific document that regulators published years ago tells you everything about who actually gets hurt when this breaks. Here is the assumption everyone reaches for first. The big banks are holding toxic office loans. Goldman, JP Morgan, Wells Fargo, the names we know. And if the big names are exposed, regulators have it covered. That framing feels solid. It fits what we learned from 2008. But the Federal Reserve's own stress test disclosures tell a different story. The 2023 annual stress test results, public downloadable sitting on the Fed's website, show large banks carrying relatively modest direct commercial real estate concentrations. JP Morgan's CRE exposure, as a share of its total capital, sits well below the thresholds that regulators flag as dangerous. Jamie Dimon acknowledged the problem directly. In JP Morgan's 2023 annual report, he wrote, "The problems in the office sector are well known and are likely to be with us for some time." That is a CEO naming the wound. It is not a CEO describing a wound in his own balance sheet. Over the past decade, large banks systematically moved commercial real estate risk off their own books. They packaged loans into commercial mortgage-backed securities, CMBS, and sold them to pension funds, insurers, and asset managers. They syndicated large loans across dozens of institutions. The origination fee stayed, the long-term risk traveled elsewhere. The FDIC's February 2024 quarterly banking profile confirmed the result. Banks collectively held $2.7 trillion in commercial real estate loans. But the distribution of that exposure is not what most people picture. Jerome Powell told Congress in March 2024, "Plainly, we do have some banks that have concentrated exposures in these areas. And some of them will have problems. Some of them, not all of them. Not the ones with trading floors and quarterly earnings calls that financial media covers obsessively. The big banks passed their stress tests. Regulators noted that, the headlines moved on. So if JP Morgan isn't holding the bag, and the stress tests confirm it largely isn't, then who exactly is sitting on $7 trillion in commercial real estate debt when the wave of maturities hits? Here is where the story gets uncomfortable. Everyone assumed the danger lived at the top. The trillion-dollar balance sheets, the names you see on skyscrapers. But the Federal Reserve's November 2023 Financial Stability Report found something that reframes the entire problem. 70% of all U.S. commercial real estate loans are held by regional and community banks. Not Goldman, not JP Morgan, the 700 smaller institutions most Americans drive past without a second thought. These are the banks financing the strip malls, the suburban office parks, the mid-tier apartment complexes. And according to FDIC call report data, many of them have CRE loan portfolios equal to 300% or more of their total capital. That number matters. 300% is not arbitrary. The FDIC itself drew that line in 2006 interagency guidance, formally flagging it as the threshold where concentration risk becomes structurally dangerous. Martin Gruenberg, the FDIC chair, said it plainly in a February 2024 speech to the Brookings Institution. Commercial real estate concentrations, particularly in office properties, continue to be a source of financial stress for some banks. Not all banks, some banks. That is the tell. When New York Community Bancorp reported a $2.4 billion loss on its CRE portfolio in January 2024 and cut its dividend by 70% overnight, it was not a warning about Wall Street. It was a warning about the tier of banking that most people never think about until their loan gets called. The FDIC's 2006 threshold has been public for nearly 2 decades. Regulators knew what dangerous concentration looked like. They defined it themselves. So the question that the next chapter has to answer is this: if the threshold was known since 2006, and the concentration kept growing anyway, what specifically changed between then and now that turned a known risk into a live detonator? Here is the number that should stop you cold. $929 billion. That is how much commercial real estate debt the Mortgage Bankers Association calculated was scheduled to mature between 2023 and 2025. Not eventually, not someday, now. The math on a single loan tells the whole story. A borrower took out a $10 million office loan in 2019. The building was worth $12 million then. Today, per Green Street Advisors research, that same building is worth $7 million, a drop of more than 25% from peak. The borrower walks into a bank and asks to refinance. The banker slides the numbers across the desk. The loan is bigger than the asset. Declined. Office vacancy hit a record 19.6% nationally in 2023. According to CBRE research, nearly 1 in 5 offices empty. This is not a cyclical dip. This is a structural rupture. The rate environment makes it worse. A loan that cost 4% in 2019 now costs 7 or 8%. Monthly debt service on the same building, at the new rate, on a lower appraised value. The cash flow simply does not cover it. There is no version of the arithmetic that works. So what do banks do when the arithmetic stops working? Some of them do not foreclose. They extend, they modify, they roll the loan forward and call it a workout. The industry has a name for this: extend and pretend. In January 2024, New York Community Bancorp cut its dividend 70% and reported a $2.4 billion loss tied directly to its commercial real estate portfolio. One bank, one quarter, $2.4 billion. Moody's downgraded multiple regional banks on office CRE exposure in March 2024. Not one bank, multiple. The FDIC reported in February 2024 that banks collectively held $2.7 trillion in total commercial real estate loans. Martin Grunberg told the Brookings Institution that month that the office sector represented the highest risk category in that entire pile. Jerome Powell told Congress in March 2024, on the record, that some banks with concentrated exposures will have problems. The Federal Reserve's own Financial Stability Report flagged the vulnerabilities in November 2023. The regulators are not hiding this. But here is the question nobody is answering loudly enough. When these loans go bad, and some already have, which banks are actually holding them? The answer is not the names on the skyscrapers. And that changes everything about who gets hurt. Here is where everything lands. The Federal Reserve's own 2023 Financial Stability Report contains a number that most coverage skipped entirely. 40% of all outstanding commercial real estate loans. $1 trillion sits not with JP Morgan, not with Goldman, not with the names you see on skyscrapers. It sits inside 700 smaller regional and community banks. Banks most Americans have never heard of. And here is the part that makes that number dangerous. The FDIC published guidance back in 2006 flagging a specific threshold. Any bank carrying commercial real estate loans exceeding 300% of its total capital should be considered high risk. Many of those 700 banks are already past that line, not approaching it past it. Jerome Powell told Congress in March 2024 that losses would be manageable. But he said something else in the same testimony. Something quieter: we do have some banks that have concentrated exposures in these areas. And some of them will have problems. Some of them not Wall Street. Them. When a regional bank absorbs losses of this scale, it does not just write down a number. It stops lending the small business owner who needs a line of credit to make payroll, the municipality trying to finance a water main repair, the family applying for a home loan. These are the people who feel the contraction, people who never owned a single office tower. That is the transmission mechanism nobody headlines. The office vacancy becomes the bank loss. The bank loss becomes the credit freeze. And the credit freeze becomes the dark storefront on your main street. Three forces could interrupt this. Loan restructuring at scale, with banks and borrowers renegotiating terms rather than forcing defaults. Regulatory forbearance, with the FDIC giving smaller banks more time to absorb losses without triggering capital requirements. Or a sustained Fed rate cut cycle that lowers refinancing costs before maturities pile up. The September 2024 rate cut was a start, not a solution. Remember that for lease sign from the beginning of this video. You know now what it actually is. A signal about who holds the note, what that note is worth today, and which institution absorbs the loss when the borrower finally stops paying. The receipts were always public. The Fed published them, the FDIC flagged the threshold in 2006. The data was there, the question was never whether this was happening. The question was always who would feel it. And the answer was never the people on the top floors. Subscribe for new breakdown like this every day.